Hello, this is Mark Sobel, U.S. Chair OMFIF. Today, I'm delighted to be in the St. Louis Federal Reserve, a lovely building, and I'm being joined by Alberto Musalem, President and CEO of the Federal Reserve Bank of St. Louis since April 2024. Alberto is a participant in the FOMC. He oversees the activities of the 8th Federal Reserve District at its St. Louis headquarters and its branches in Little Rock, Arkansas, Louisville, Kentucky, and Memphis, Tennessee. Prior to joining the Fed, Alberto had a wide-ranging career in economics finance. He was CEO and co-chief investment officer of Events Asset Management, a firm he founded. From 2014 to 2017, he served as executive vice president at the Federal Reserve Bank of New York and senior advisor to the bank's president. From 2000 to 2013, he held many positions: managing director, partner, global head of research at Tudor Investment Company Corporation. And if you can remember this far back, we first met when he was a young economist at the International Monetary Fund, put into a very sensitive role overseeing Brazil's external developments during its 1998 crisis. So questions from the audience, we'll entertain a few at the end. They can be submitted in the chat function. And so, Alberto, thank you for allowing me to visit the St. Louis Fed, and it's a huge pleasure to be here with you today.
So, Mark, welcome to the St. Louis Fed. It's great to have you here, and we're looking forward to our conversation.
Great. Well, hopefully I'll get to ask you a few tough questions, but let me start off with the softball for you. So when I talk to Fed officials, I usually just lead off by asking them for a thumbnail sketch of the economic outlook and its meaning for monetary policy, and then I drill down into the details. So let's do it this way. What's your overall thumbnail sketch on the situation?
So the economy is in a good place. The labor market is at or around full employment. It has some downside risks, but it's looking stable and good. Inflation is running somewhat above our target. There are some upside risks to inflation looking ahead. Monetary policy is modestly restrictive, and financial conditions are supportive of growth.
Okay, very pithy. Okay, well, let me ask you a bit then about some of those things that you just said. So I find the inflation outlook baffling. First of all, there's just so many measures you can look at between sticky, trimmed, core, headline, et cetera, et cetera. But my overall take was inflation had gone down to around 2.5%, but then things for the outlook became more complicated. So there have been some restrained readings lately, owing in part to lower energy prices, but energy prices have been jumpy. We're still awaiting perhaps the impact of tariffs. Immigration may impact inflation. The dot plot median was for 3.1% core PCE increase in 2025, well above the 2% target. So can you make it all crystal clear for us?
Well, I'll offer my view. So our target, as you know, is in terms of headline PCE inflation. Mm-hmm. It's really important to form a picture of what underlying inflation actually is. I believe the best measure of underlying inflation is core PCE inflation. That has been running on an annual basis year on year at 2.7%, which is above our target by 0.7%. On a 3-month basis, though, we've had some very positive inflation trends in core, in headline, in goods, and in services, and those are very welcome developments. It's important that those developments be sustained and sustainable over time. The outlook for inflation that I have, and it's in accordance with what many private forecasters have, is for inflation to increase going forward, mostly owing to tariffs, which may settle somewhere between the low teens or the low 20s, depending on trade policy.
The average effective rate.
The average effective tariff, yes.
Okay, well, let's ask about that and tariffs. As I said, we really haven't seen an impact of tariffs yet, I don't think. But there's a bit of a debate, and perhaps it gets caricatured a bit, but there's one camp in the media which is portrayed as seeing the potential impact of tariffs as transitory, one-off, and the argument is made that maybe we should look through it. Others suggest perhaps there could be second-round effects and the like, and we should be cautious in adopting a look-through strategy. Hopefully I characterize the debate somewhat correctly. How do you fall in that?
So tariffs could have a temporary effect on inflation and a one-off impact on prices. They could also have more persistent impact on inflation. From my perspective, it's too soon to tell which way it's going to go. There are good arguments on both sides. So let me just offer the arguments and why I believe it's too soon to tell just yet. So the arguments for a one-off impact on the price level and a very short-lived impact on inflation are that economics tells us so. Economic textbooks tell us that all else equal, of course, things are never all else equal, but all else equal in a vacuum in a textbook, you should expect exactly that, for tariffs to rise, for those increases to be passed on to consumers as one-time price increases, and the impact on inflation to be very short-lived. Other reasons why it might be short-lived is companies who are the deciders here in terms of how much to pass through or not, have built inventories, so they have buffers like inventories.
Right.
And if you look at profit margins, they're pretty high in the U.S. economy right now, so there's some room for absorbing, the cost increases from tariffs on imports. That's another reason why it could be the pass-through could be limited or temporary. Also, when I get around the country and I talk to companies, you hear different pass-through narratives. So when you talk upstream to the importer, the initial importer, they say we're going to pass on 100% of the tariff increases. As you begin to talk further downstream, the conversation begins to change, and when you talk to the final retailer that is going to face the final sale to the consumer or to the final purchaser, they say it's going to be a little harder to pass on. So there are different stories, and that could limit the impact of pass-through and the duration of persistence. So that's that part of the story. On the why could it be more persistent? It could be more persistent because tariffs apply, in this case, apply to intermediate goods. And intermediate goods are inputs into the production of final goods. And tariffs on intermediate goods could affect the prices and inflation of non-imported goods and services. So that could be an indirect effect that we need to be mindful of. And in terms of second-round effects onto actual inflation, it's important to recognize that we've been above our inflation target for 4 years now. Businesses and households are very sensitive to inflation nowadays. Inflation expectations at the front end of the short-term inflation expectations have risen, although they have declined more recently. Long-term inflation expectations have remained anchored, with the exception of the Michigan survey. So we have to be mindful of that in understanding second-round effects. And the dollar has depreciated, and that could contribute to inflation going forward. So there are good arguments on both sides. I think it's too soon to determine which of those outcomes is most likely. And it's too soon for the following reason. If you look at what people are actually paying in terms of tariffs, if you look at tariff revenues divided by imports, the theoretical or the expected effective tariff rate is somewhere between the low teens or the low 20s, depending on where trade policy ends. But the tariff revenue relative to imports has not achieved that level yet, It is rising. It rose from 2.5 before April to something like 4 in April to something like 6 or 6.5 in May. We expect it to get close to 8 or 9 by June. So it's going to take time for the tariffs to settle what people are actually paying and therefore how they're passing through. When we look at surveys, and these are publicly available surveys by several reserve banks, the expected time that companies are working with in terms of pass-through is something like 3 months after feeling the initial price increase, whether directly or indirectly. And so, there's a scenario where we could be in Q4 of this year or Q1 or Q2 of next year, and tariffs are still working themselves through the economy.
Okay, well, thank you. So, in essence, it isn't that you may not buy into the look-through scenario or not, but it's a question of the balance of risk for you.
Indeed.
Maybe you could elaborate about a bit more, because in your answer you talked about having been above target and for a while, and inflation expectations not being necessarily well anchored. A lot of the surveys, I guess, show 3%, I think, as New York Fed. Given that the pandemic showed how sensitive Americans are to inflation, does that weigh on your mind additionally when you think about the outlook for monetary policy?
So it's critical that we maintain anchored long-term inflation expectations. It's critical, it's a necessary condition to attain price stability. Anchored inflation expectations are also really important because they allow us to conduct and have a dual mandate where we can be responsive to the labor market or to fluctuations in economic activity. If inflation expectations are not anchored, that becomes more difficult to do. So it's a critical asset that we must preserve. When I look at inflation expectations, they are anchored, so I did not say they're unanchored.
Apologies, my mistake.
They are anchored. The long-term inflation expectations are anchored, whether you look at survey measures. The New York Fed survey measures of 3 and 5 year look pretty anchored to me. The Michigan survey is an outlier. There's been some methodological changes there, which we can discuss. But we have to look at that, not discount it, but not place tremendous weight on it. So, and if you look at market long-term inflation expectations, they seem rather anchored to me, very anchored to me. If you look at short-term inflation expectations, whether survey or market-based, they both rose after April. The survey measures have fallen back. The market measures have fallen back also, but to elevated levels. So something I'm focused on is to make sure that short-term inflation expectations don't contaminate, don't seep into longer-term inflation expectations.
Okay, well, let's shift then to the other part of the dual mandate. So private forecasters are projecting a fall off in growth in the second half of this year. I assume the dot plot embeds that all as well. I've heard officials suggest that the labor market is holding up well. Others have said that if labor market softness accelerated, the Fed may asymmetrically emphasize the maximum employment leg of the dual mandate. But there again, there are those who may suggest that the unemployment rate may hold steady because the supply of labor due to immigration, lower immigration flows is weakening. So, and that the demand could be falling, but because of the supply offset, the unemployment rate wouldn't change. So, is the labor market solid? Is it softening? How does this feed into your view of the dual mandate?
It's very important to maintain a very broad view of the labor market, not reduce it to one number, one statistic, and you have to look at all of it. There's some very large gross flows that happen underneath the surface, and that's really important to look at. As I said at the beginning, from my perspective, the labor market is stable.
Yep.
At full employment, which is a good place to be. When you begin to look under the surface, labor supply, as you said, seems to be declining, and you can see that in the participation rate has been declining. It's possible that is related to lower immigration flows. It's possible that may be due to other factors, entry into the labor force. When you look at labor demand, what the numbers say, and also what I hear when I go around the country and around our district, is companies with the uncertainty they've been facing this year have held back on hiring. So hiring trends have been softer than usual. So both supply and demand in the labor market seem to have cooled at the same time. On the demand side, one thing that's interesting is vacancies have been rising lately. So while the hiring is low, some increase in vacancies, meaning more jobs, which is interesting. So in sum, we're in a low hiring, low firing environment. When I go around and I talk to companies, and I talk to a lot of companies, I'm not hearing about layoffs. I'm hearing that folks are reluctant to do that because they faced severe labor shortages after COVID. So they're reluctant to separate from their workers. So that's how the labor market looks. Now there are some downside risks. Firms will likely face profit margin pressures, and I'm watching the downside risk closely to the labor market. Continuing claims, for example, continues to rise. This morning's number indicated that trend, although new claims is stable or falling, which is good news. When you look at the Warren's layoff notices, they ticked up a little bit, so that's something I'm watching. When you look underneath the labor market report, hours worked ticked down, compensation ticked down a little bit. And when you look at private payrolls, you can see some softness there. So there's reasons to be mindful of downside risks.
What do you think about the stagflation word?
Oh, before we get there, you asked me about monetary policy in the labor market. So I think policy is well positioned to respond to labor market weakness, that is undesired labor market weakness. Provided underlying inflation can be expected to continue to converge towards 2%, and inflation expectations remain anchored. And you used the word asymmetric, and I don't view it as asymmetric. We have a dual mandate. We have to be alert to two things, provided inflation expectations are anchored. So to me, it's a feature of the dual mandate, not an asymmetry to it.
Okay. Well, the proponents of asymmetry have heard you speak. Again, stagflation, what do you think about that?
So I don't think we're in a stagflation environment. For me, that term connotes inflation much higher than here, and unemployment much higher than here, or where I expect it to be in the next 12 months or so. So I think we have risks of inflation moving higher, and we have risks of the labor market softening. I'm not seeing right now what I would call stagflation, which for me would be when the sum of unemployment and inflation is somewhere above 9.
Okay.
We're not anywhere near that.
All right.
Yeah.
Although maybe we'll need to retool definitions of stagflation from the 70s to the 21st century. In your opening, you said financial conditions are moderately restrictive, and I look. There's so many financial conditions, indices, and whatnot, but I looked at the Chicago Fed one because that's publicly available, and it didn't look all that. It almost looked accommodative. But then the argument is also made that with Fed funds at its current range, and even with inflation, let's say 2.75%, 3%, whatever it be, that is a not inconsiderable real rate. would you care to elaborate a little bit on this issue of financial conditions and how you see them?
Thank you. So what I said at the beginning is that monetary policy is modestly restrictive.
Okay.
And financial conditions are supportive
Okay.
of economic activity. I did not say they were restrictive, so I'm agreeing with you on your assessment.
All right. Well, I need a lot of correcting.
We need to be precise in this job, as you know. So when I look at financial conditions, I try to look at them in two ways. I look at all the indices that you mentioned, which are all based on prices or yields determined in financial markets. And I also try to look at quantities of financing to the economy. I try to look at both things. So my assessment when I look at both, whether it's, I look at many indices and I look at, try to look at the sum of all the financing to the economy. When I look at both, I see financial conditions that are supportive of economic growth. That's why if you think of the transmission from monetary policy to financial conditions to the real economy, I'm not observing a tremendous amount of restrictiveness there. And that feeds into my assessment that monetary policy is modestly restrictive. Also the financial stability report that we released suggests that asset prices were elevated, which is consistent with financial conditions being supportive of economic activity.
Well, great. Well, that's a perfect segue into my next question, which is that we talk about the dual mandate of the Fed, but the Fed also has very significant financial stability responsibilities. My sense is that the last Fed financial stability report expressed concerns about high asset valuations, as you mentioned, limited liquidity in treasury markets, the need for commercial real estate refinancings and hedge fund leverage. And then there are proposals out there now about the enhanced supplementary leverage ratio, which could reduce GSIB capital. So going back to my past and working at the time of the global financial crisis, I worried that financial regulators and supervisors may not have a full handle on non-bank financial institutions, and including their interactions with the banking system. And that view was reinforced by Archegos and Silicon Valley Bank, et cetera. So I guess the question for you is a very broad question, but anything you would like to amplify on, of course, is welcome. But should Americans be concerned that we are forgetting the lessons of the global financial crisis?
So the banking system is well capitalized today, and it's liquid. It's much in contrast to what happened at the eve of the global financial crisis, where the banking system was not well capitalized and turned out it was illiquid. The 2025 stress test results were released recently, as you know, and they show that the largest 22 banks can withstand meaningful losses, I think up to $550 billion, if I'm not mistaken, and continue to be well capitalized and continue to lend to households and businesses even after severe economic and markets shocks are simulated. So that's something important to keep in mind. In terms of non-bank financial institutions, so that is private equity, private credit, hedge funds, insurance, money market funds. It's a broad set of financial market participants. They have been growing very meaningfully since the global financial crisis, maybe in part because of the regulation on the banking system after the financial crisis. And those risks, financial stability risks, need to be well monitored. They need to be well understood. When we look at the exposure of banks, I think you mentioned that, to the non-bank financial institutions segment of the financial system, it has been growing also as that sector has been growing. It stands at around 10% now of total loans. It is not particularly concentrated on any one segment of the non-bank financial institutions set, it tends to be of investment grade quality, and it tends to be at a lower delinquency rate than exposures to non-financial institutions. Also, if you look at the stress tests, they show that the largest banks can withstand meaningful stress to their non-bank financial institutions' portfolios and continue to be well capitalized and lend. So it's something that I'm certainly very interested in from a financial stability perspective. There's been when there's a high growth area of the financial system, you have to watch it carefully.
Right.
And this has certainly been one. That is what I can share now.
Okay. Well, thank you for that. Well, I hope we're highly vigilant to the interactions between the banks and the non-bank financial intermediation. Seems a area that could always cause trouble if not well overseen. Well, let me shift gears again on you. So in Econ 101, we learned that fiscal and monetary policy interact and that large deficits can push up medium and longer term rates and slow investment in the economy. We're running very large fiscal deficits now, some 6% of GDP, and CBO projects that trend to continue for the foreseeable future. At the same time, changes in official short-term rates have limited influence on the long end of the curve. Do you have thoughts on the implications of our current fiscal settings for the economy, yield curve, financial markets, the dual mandate?
Fiscal policy is not the domain of the Fed, so I can't comment on the specifics.
Of course.
It's not my job to comment on the specifics of fiscal policy, but I
But
can
we were
say
both at the IMF, and there everything's about the fiscal monetary balance, as you well remember. So there must be some interaction there.
Fiscal deficits of around 6.5% for a sustained period of time at full employment, when you compare that across countries and across time, are large deficits. And my assessment of the fiscal trajectory that the U.S. has been on for a number of years now, more than a decade now, so this is something that's been going on for a while. It's on an unsustainable trajectory and
Yes,
path.
absolutely.
And if sustained over a long period of time, and we were just talking about financial stability, it could become sometime in the future a financial stability problem that I'm certainly looking at and trying to understand. Your other question was about the impact on markets. Governments compete for funds with private sector borrowers in financial markets. Higher fiscal deficits mean more borrowing. That competition for funds could push up interest rates, long-term interest rates, which are beyond the Fed's control. It is possible that large fiscal deficits could lead the public, this is households, businesses, and financial market participants, to expect higher risks of inflation. That could require a higher compensation for inflation in long-term interest rates. And if long-term interest rates stay high or rise, that could limit growth and could limit employment. So,
Well, good. Thank you for that. And as you said, fiscal is not in the mandate of the fund, so I'll move on and shift gears again, and to something that is in the Fed's remit, which is the framework review. So I sometimes see blame ascribed to the 2021 framework as a contributor to the high inflation that we experience. I always felt that the last framework review was, in a way, designed to fight the last war, the War of the Great Moderation. And even if one wishes to argue that the Fed was too late to respond, nobody could have foreseen the pandemic and its ramifications, plus the impact of the fiscal largesse at the time. So I guess I have questions in my mind about the A and FAIT, whether the Fed funds rate is the proper target variable, et cetera, et cetera. But what are you thinking? What are your thoughts about the review? What would you like to see come out of it? Even though it's ongoing, and it would probably be premature to draw too definitive conclusions.
So the FOMC has been working on the review since the beginning of the year. It's been a very thoughtful and very thorough, look at the monetary policy framework. We've had some fascinating, discussions. There's been a broad consultation with stakeholders through Fed Listens events around the country. We've consulted with academics. We've had conferences. So it's a broad consultation on how to think about this. As you said, the FATE, Flexible Average Inflation Targeting Framework, that was released in 2019, was very much designed with the asymmetry of the zero lower bound on nominal interest rates in mind, and the risk of disinflation or deflation as something that we should try to avoid. So it was very loaded on that one scenario, which we had been living in for 10 years at the time in 2019. What I would hope to see, I can't prejudge the outcome because it's still ongoing, but what I would like to see in a new framework is a framework that is more robust to different economic environments and more normal economic environments that are not the zero lower bound, while at the same time being mindful that the zero lower bound asymmetry is still a possibility, so not totally ignoring it, but not totally focusing on it. So that's what I would like to see come out of it. In terms of the federal funds rate, I think was your other question.
Well, I'm trying to draw you out on what you would like to come out of it, but that's another thing that's on the docket, as well as communications and the like.
Yeah. The way, and I think Chair Powell said this at a conference recently, so the framework review, I would expect it to be done by the end of the summer. And then after that, we are working on what communications may look like, and we'll be looking at that in the latter part of the year. Your question on the Fed funds rate as the instrument, the FOMC has been conducting monetary policy effectively with the federal funds rate as its target. And right now, I know there are proposals there and views there that other interest rates ought to be, other markets, other parts of the money market ought to be considered as the target. Right now, the federal funds is being very effectively used, and it's unclear to me that a transition to another instrument at this point in time would make monetary policy implementation more effective.
Okay. So we can expect a FIT, but not FATE Fed, perhaps.
Maybe.
Since we just did mention instruments a little bit, and this gets into a very technical area of balance sheets in the Fed, but you worked at the New York Fed, so you're undoubtedly familiar with monetary policy operations and whatnot. So there seems to be talk about going from, is it abundant reserves to ample reserves? I don't know what these distinctions mean, but they're general concepts. But maybe you can elucidate all of that for us. But is there much farther to go? What should we be looking for? And I noticed recently some proposals in political circles about paying interest on excess reserves and whatnot. And I was wondering when I read them if one could run the current Fed system without paying interest on excess reserve balances and the like. So what can you tell us about the framework, about the balance sheet and where it's headed?
That is a lot of technical questions there. So the balance sheet reduction has been ongoing. The draining reserves has been ongoing, and it's been happening in a smooth, effective way for some time. What abundant reserves means is that there are sufficient reserves in the system such that the equilibrium in the money market is occurring in the flat part of the demand curve for reserves. And what ample reserves means is that the money market is operating at an equilibrium that is no longer at the flat part of the demand curve for reserves, but rather begins to get into the less flat or maybe steeper part of the demand curve for reserves. Nobody knows where that transition will be because it depends on where the demand curve is at any point in time. The FOMC monitors that, and the New York desk monitors very carefully many indicators to help us understand whether we're in the flat part of the demand curve for reserves or beginning to get into the steeper part of the demand curve. Thus far, it appears that we continue to be in the abundant reserves part of the money market, or the money market is in an abundant reserve state. So we will know when we get signals that the demand curve for reserves is becoming steeper.
What would that signal be?
So the New York Fed monitors exactly that, the elasticity of of reserves to interest rates. So that's the slope of the demand curve for reserves. And we monitor also many other indicators. So it's a multidimensional monitoring to understand whether we may be transitioning from one regime to another. You may have noticed that there was a reduction in the rate of balance sheet roll-off earlier in the year. And the idea was to make sure that when we get to that transition, that the transition is smooth and not abrupt. You asked a question about, the second part of the question was?
Interest on.
IOER. So if interest on reserves went away suddenly, commercial banks would reduce their levels of reserves, and that would inject liquidity into the money market. And to maintain interest rate control, the Fed would then probably have to sell Treasury securities in the market to reduce liquidity. The ample reserves or abundant reserves regime requires interest on reserves for interest rate control. That transition from what would be an ample reserves to, let's say, a scarce reserves, if the IOER went to zero, could be disruptive and could be a difficult transition. And if we were to operate in a scarce reserves regime, which the Fed did before the global financial crisis, managing liquidity in the money market requires more active open market operations to adjust to shifts in the demand curve or in the demand for reserves. So it requires more active management, and the benefit of an ample reserves regime with IOER is that it allows the Fed to inject liquidity quickly into the market if there's a need for quick liquidity injection without losing interest rate control. In other words, without compromising monetary policy. So that's the benefit of it.
Thank you. I think that's a very valuable explanation for the public that I haven't heard from a Fed official before. Okay, well, so when we first met and you were working at the IMF, and then you became a hedge fund manager, and you invested globally. So you are no stranger to international economic trends. So, I recall in the 90s, if one asked the Fed what role international developments played in monetary policy, I remember this Greenspanian line about considering them to the extent that they impacted the dual mandate and the optimal functioning of the U.S. economy. And at the time when I heard it, I felt that he had mainly in his mind, the real channel. But since then, we've gone through global financial crisis, the pandemic, the dollar is the dominant global currency. And we've seen how potent the financial channels can be in international ramifications and influences. So how do you think about international developments and the dual mandate? And then very more technically and specifically, I've read a lot of stories lately about voices that are wringing their hands about how the Fed might suspend its overseas swap lines. I don't really understand those stories, but if you had anything to say on that as well.
A lot of questions there. On international, so what the FOMC is squarely focused on is the dual mandate and achieving maximum employment and price stability for the American people. That's what we do. Now, the U.S. is undoubtedly very connected to the rest of the world, perhaps less so through exports and imports, but very much so through capital flows and investment flows in and out of the country, whether it's American businesses and households investing abroad, or whether it's foreign households and businesses investing in the U.S. There's a big connection. The financial channel there is very connected. As you know, we have the deepest, largest real economy markets and financial markets in the world. It's also the most innovative economy in the world. So, not surprisingly, foreign investors want to invest in the U.S. So there are a lot of connections. I monitor financial developments constantly, whether they are through the real side or through the financial channel, to understand how they can impact our dual mandate. So employment and inflation. At FOMC meetings, we spent a meaningful part of the meeting looking at what's happening in other parts of the world and how that can affect us. So a lot of investors want to hold U.S. assets because, again, it's a very innovative economy. They fund those assets sometimes in U.S. dollars, so they need to borrow in U.S. dollars to be able to invest in our markets. And you mentioned the dollar swap lines. In times of stress, the dollar swap lines, which, by the way, are collateralized lending, so they're safe lending.
Right.
The dollar swap lines allow foreign central banks to lend to foreign investors that want to invest in U.S. markets and U.S. assets. So dollar swap lines help with financial stability for U.S. markets and U.S. assets, and financial stability is a good thing for U.S. households and U.S. businesses.
Thank you. It struck me that in times of stress, the Fed's become the reluctant global lender of last resort, but the swap line is very important, and I think you make very strongly the point that the swap lines are in the interests of the health of the United States of America. It's an important point. You're the president of the St. Louis Fed. So first of all, the St. Louis Fed is known around the world for Fred, and it is a phenomenal global public good. I have nothing but the highest of praise for Fred. So keep that up. Keep maintaining Fed and its excellence. Or maybe you could tell us something about the challenges facing the region, and then I'm going to ask you a broader question about being a regional Fed president and monetary policy. You formulate U.S. policy, monetary policy, along with others. And of course, a country can only have one monetary policy. You can't have a St. Louis monetary policy and a San Francisco monetary policy. But being head of the St. Louis Fed and understanding the region must impact and influence you somehow when you go into the FOMC. So I was wondering how you balance those considerations. How does being a regional president trying to make national monetary policy weigh on you?
So three questions there. Well, one
I got to get in as many as I can, Alberto.
one accolade, which was Fred. So thank you for recognizing Fred and for the plug for
Yeah.
Fred. Our team puts a tremendous amount of effort into Fred, and we view it as a critical tool for economic education, free economic education, and so thank you for that. In terms of the region, our region is very diverse. So the 8th District has 7 states or parts of 7 states. From the north of the country to the south of the country, from the west part of the eastern part of the country to the eastern part of the western part of the country. And so it's very diverse, and there are some areas that are doing very well. There are areas that are more challenged, and we try to visit with everyone and make sure that we're gathering everyone's all the views of stakeholders on how we do monetary policy and how to balance the regional views with the national views. So I meet with a rich set of stakeholders in preparation for every FOMC meetings. A lot of those stakeholders are in our district, but I also meet with stakeholders that are national and global. Interestingly, even when meeting with stakeholders from our district, some of the largest logistics companies in the world are in this district. Some of the largest retailers in the world are in this district, and they have global operations. So even when going around the district, you get the local view and you also get the global view. So I bring that informs my FOMC views, along with a lot of sophisticated modeling and data watching, but also the impressionistic view. And I share my regional, national, and global views at the FOMC. Other presidents do the same, and that's required. I mean, that's the beauty of the federal, decentralized, federalized system of the Federal Reserve. Is this is a large country, a complex economy, and it's important to bring all the views from all the regions to the table. And nobody argues for, let's set monetary policy for my district. We all recognize that it's a complex country. We put all the views from around the country and to formulate a monetary policy for the country. Interestingly, when we are sharing these views and debating these views, sometimes there are a lot of people around the table, and sometimes there are a lot of similarities in what you're hearing across districts, particularly around turning points. You kind of hear one district say one thing, and the other district says something very similar unexpectedly. And so, and sometimes there are big differences. So, and that's the beauty of many views, many perspectives, to form the best informed decision.
Okay, I think that's. There have been debates about, do we need this comprehensive regional Fed structure and whatnot. And I think you just made an eloquent defense of that. We had said that at the end we would have some time for audience questions, and they've been filtering into me. And there seem to be just tons of questions about tariffs. Now, you dealt with tariffs quite a bit in your earlier answers, but there are many more questions about how do you track pass-through. Do you have times in mind when you're going to be looking for when tariff is being seen in inflation, or you might come to the view that the Fed is behind the curve, questions about supply chain disruptions and whatnot. I could go on, but it seems to be a very popular question, including about whether your community contacts and how much they've had to say to you about tariffs and inflation and whatnot. So in view of these audience questions, would you like to elaborate on your views on tariffs and inflation and whatnot?
Thank you. So on supply chain disruptions, we're not hearing a lot of that in our conversations, and there are many indices out there of supply chain disruptions, and they're also not suggesting a lot of supply chain disruptions. As I said when we started, we hear a lot of companies, particularly larger companies, not so much smaller companies, did build a lot of inventories at the beginning of the year and did pull through a lot of their imports. So that contributes to no supply disruptions at this point that can be observed. In terms of measuring, disentangling, what is underlying inflation, what is an indirect impact, what is a pass-through, and what is a second-round effect, that's hard to do. It's really hard to do. Our teams are doing that, and they're looking at prices by different types of goods that have been tariffed, goods that have not been tariffed, and they're trying to parse out, what is the tariff impact. And so far it's mild, although we only have 2 months of price data after April. And as I said at the beginning, the actual tariffs being paid at the border have only been increasing, linearly towards the expected low teens or somewhere between low teens and low 20s. So it's early to understand the full effects.
And do you have I think you already kind of said this towards the end of the year versus the first quarter of next year. That's kind of when you would expect to have a more comprehensive view of the fullness of the impact of tariffs as we now understand them in terms of the inflationary impact. And there was another question about there's trade deals and how they might pan out, but there seems to be so much uncertainty. One really can't figure that out. So is that the right time frame to look at, is towards the end of the year, first quarter of next year, for the inflation impact from tariffs based upon what you'd expect today? And again, these are questions that are filtering in. You're popular on tariffs.
So every piece of information helps.
Yeah.
We can't have analysis paralysis where we are waiting to have 100% clarity on everything before the nature of central banking is decision making under uncertainty. I think as we progress through the year, I'm going to get more comfortable in understanding what the total impact of tariffs may be. I expect that to begin to show up in data with June, July, August, September data. I don't expect it to be the end of it, but it's possible. I may be able to form a picture by October, November, December. It's possible I may not form a picture. Again, I'm not looking for a complete certainty, but I'm looking for sufficient confidence in one direction or another.
Okay. Let me just put to you a question from left field, and because it's an important part of the monetary policy discussions these days. And I know that there's a lot of activity in Congress, and you wouldn't want to comment on that. But just, do you have any? What are you willing to tell us about your thinking on stablecoins and central bank digital currencies?
So on the latter, there's an executive order that precludes the Fed from being engaged in central bank digital currencies. So at present, we're not doing any work on that. On stable coins, they're an interesting innovation in terms of the payment system of the U.S. And the world. It's very interesting technology. We have an act or a bill going through Congress right now to provide a regulatory framework for stable coins. We may be a regulator in that act. We're observing it. It's too soon to conclude, but it's a great thing that there's going to be a framework, a regulatory framework around this, because stablecoins could become a very important part of the payment system. We've already seen, two very large retailers saying that they're studying issuing stablecoins. We've seen very large banks saying they are studying issuing stablecoins. I've heard from bankers in Europe, large bankers in Europe, saying that they're thinking of issuing dollar-based stablecoins in Europe. So it's a very interesting development that we need to be on the front foot of and understand well.
Okay, I have last question then for you. This is in the motherhood and apple pie category. It's an easy one for you, but the Fed has instrument independence. Obviously, Congress sets a dual mandate. The chair testifies. Fed chair and vice chairs and the board of governors go through an accountability process with the Senate for appointments and whatnot. But again, you have instrument independence. I would take it you're a big believer in central bank independence. So one of the questions was for the public, what are the benefits of central bank independence, and are you a true believer in it?
So central bank independence is really important because if you look at empirical evidence across many countries and many years, so a lot of data, countries that have had more independent central banks have delivered better inflation and better employment outcomes for the people they serve, meaning lower and more stable inflation and higher and more stable employment. So that's well documented. As you said, I worked at the IMF a long time ago, and I also worked at an investment company where we invested in countries all over the world. So I also observed that empirical evidence to be true in my own career. So it's an important thing, and it's important because going back to inflation expectations, countries with more independent central banks are able to control inflation expectations and keep them anchored better. And if they can keep inflation expectations anchored better, that means they can be more responsive to employment and activity when there are shocks to the economy. So it's a good thing to be able to do that. Central bank independence, as you said, comes with accountability, must have transparency. And as you said very well, we at the Fed have instrument and operational independence, but the goals of maximum employment and price stability are set by Congress, and there's accountability to Congress.
Well, thank you for that. Oh, we've come to the end of our time, and plus you probably have a real day job to do instead of talking to me. This has been a wonderful interview. I hope it's given the public, or more people in the public, the chance to see how bright, thoughtful, and you are, and how much wealth of experience you bring to the current job. So I thank you for that. Thank you to the St. Louis Federal Reserve Bank and all of your team for helping out, and tremendous thanks to you. And it's great to see you, and it's a great reminder that when we first met in the late 90s, I was asking you lots of questions then, and here we are almost 30 years later, and I'm still getting the great opportunity to ask you questions.
Mark, it's great to have you in St. Louis. It's great to catch up again. Maybe one day I can interview you.
Well, I won't have anything nearly as intelligent and profound to say as you.
Thank you, Mark. It's great to have you here.
Thank you.